Good day, everyone. We are the second group, and today we'll be talking about capital structure, financial structure, optimum capital structure, and capital structure theories. So, the first one is capital structure. Capital structure refers to the way a company finances its operation and growth through a combination of debt and equity. It plays a critical role in financial decision making as it affects the cost of capital or how much it costs you to get money, risk or how risky your business is, profitability or how much profit you make, and the overall value of the firm or how valuable your firm is or your business is. So, in shorter terms, ang capital structure is ito na yung way or paraan ng isang company para pondohan ang operation and growth niya while mixing debt and equity. So, mayroong two components ang capital structure. Ito na ang equity capital at debt capital. So, ang equity capital, it consists of funds raised from owners and shareholders. This includes common shares and preferred shares. So, ang common shares, ito na sila yung mga common stockholders that have voting rights and may receive dividends. Pero, usually, they are last in line to claim asset if the company dissolves. While, ang mga preferred shares naman, ito na yung mga shareholders usually get fixed dividends and have priority over common shareholders during liquidation, pero they often lack of voting rights. Then, ang debt capital naman is ito na yung mga utang or yung money borrowed and must be repaid with interest. Then in here, it has types. It includes long-term loans, bonds, and short-term liabilities. Ang long-term loans, ito na yung mga bank or private loans payable over several years. Bonds, ito na yung mga debt securities issued to investors promising periodic interest payment. And yung short-term liabilities naman, ito na yung mga credit lines and commercial paper due within a year. Bakit ba ito importante? Or ano ang importance ng capital structure? Capital structure influence, first, a company's financial stability and performance. Nakakaapekto ang capital structure sa financial health ng company. Like for example, kung sobrang utang, delikado ito kasi mahirap pa sila magbayad, lalo na kapag bumaba ang kita nila. Kaya need na balance ang debt at equity para mas stable ang company. Then next, or the second one, is ang investor perception and confidence. Kasi diba usually, tinitingnan ng mga investor kung paano na-handle yung capital structure. Kapag mataas ang utang, isipin nila na risky to. So, parang mawawalan sila ng tiwala dun. Kaya, pwedeng bumaba ang interest nila sa company. The third one is the cost of capital or interest for debt and return expectation for equity. Kasi 'di ba, ang utang or yung debt may interest talaga. While ang equity naman is may expected return. So kung maayos ang capital structure or balance siya, nababawasan ng overall cost ng funding na nakakatulong sa kita or income ng company. And lastly, the fourth one is ang risk level, especially related to default and financial leverage. Kasi as you can see, mas mataas ang risk kapag marami ang utang. Kaya importanteng balansehin ang debt at equity para kontrolado yung financial risk ng isang kumpanya. Factors affecting capital structure. First one is nature and size of the business. Usually kasi yung mga malalaking businesses or bigger or larger businesses is mas madali sila maka-access sa iba't ibang source ng funds like loans and equities. Pero yung mga maliliit or small businesses is limited lang yung choices nila. Second one is business risk and earning stability. Kapag stable yung kita or maliit yung risk ng negosyo, mas confident yung company na gumamit ng utang. Pero kung malaki naman ang risk at pabago-bago ang kita, mas safe na mag-issue na lang ng equity para hindi maapektuhan ng interest payments. Third one is yung cost or availability of capital. Kung mahal ang interest o mahirap makakuha ng utang, pwede silang mag-focus na lang sa equity. Pero kung mura yung interest at madali makakuha ng fund, mas okay yung debt. Fourth one is market trends and economic conditions. Kapag maganda ang economy or ang stock market, mas maganda na mag-issue ng equity, pero kung economic downturn naman o mataas ang interest rates, mas pipiliin ng iba na mag-utang na lang or internal funds. Panglima is tax benefits. Dito, ang situation dito is parang ang interest sa utang is deductible sa tax. So, isipin nila na mangutang na lang sila kasi mas nakakatipid sila sa buwis kapag marami silang utang. Then lastly, or pang-anim, is ang control considerations. Dito kasi kapag nag-issue ng equity, it weakens the ownership ng original shareholders. Kaya kung ayaw nilang mawala ng control sa kumpanya, mas prefer nila ang utang kaysa siya mag-issue ng bagong shares. Optimal capital structure. An optimal capital structure is the best possible mix of debt and equity that minimizes the company's cost of capital while maximizing shareholder value. This structure is not fixed, it varies based on industry, company goals, and market conditions. Sa madaling salita, ang optimal capital structure ay mahalaga dahil ito ang nagpapabalanse sa utang at equity para mapababa ang cost of capital at mapalaki ang value ng kumpanya para sa mga shareholders. And also, dahil iba-iba ang industriya, goals ng isang company at kondisyon ng merkado, need itong i-adjust ng maayos at ayon sa sitwasyon para masiguradong sustainable ang growth ng isang business. Theories of capital structure. So dito, I will explain it to you briefly lang since Miss Kana will explain this to you later on. So first one is net income approach. Ang idea nito is mas maraming utang, mas bumababa ang cost of capital at tumataas ang value ng kumpanya. Next one is net operating income approach. Dito sinasabi na walang epekto sa value ng kumpanya ang capital structure. Third one is Modigliani-Miller theorem. So parang same lang sila ng net operating income approach, pero dito, sa perfect market daw is walang epekto ang capital structure sa value ng firm. The next one is trade-off theory. Dito, binabalanse ng kumpanya ang tax benefit ng utang at ang risk ng financial problem. And lastly, pecking order theory. Dito, mas gusto ng kumpanya na gamitin muna ang sariling pera or internal funds tapos mangutang or tapos ang debt, then ang panghuli is mag-issue ng equity. Real-world application. Different industries adopt different capital structures. For example, tech companies often prefer equity due to high growth potential and volatility. Example nito is Facebook raising equity in early years to fund rapid expansion. Manufacturing firms. Typically, they use a mix of debt and equity to fund asset-heavy operations. They need stable capital for machinery investment and can handle steady debt repayments. Small businesses often rely heavily on owners' personal equity or short-term loans, as they might lack access to larger capital markets and want to avoid loss of control. In conclusion, capital structure is fundamental aspect of financial management. A well-chosen structure can reduce financing costs, increase profitability, and support sustainable growth. Regular review and adjustment of capital structure are necessary to adapt to changing financial conditions and strategic goals.
Good day, everyone. So, today I'll be discussing the financial structure. So, what is financial structure? Financial structure refers to the combination of all the financial sources a company uses to fund its operations and grow. This includes both liabilities or debts and equity or owners' funds. Understanding financial structure is crucial in accounting because it influences a company's risk, cost of capital, and ability to grow sustainably. This topic is important because it helps us understand how businesses fund their operations and grow over time. We will look at its components, its role in decision making, and how companies maintain balance between debt and equity. So, let's move on to the components of financial structure. Financial structure is made up of three main components, which are first, the short-term debt. This includes money the business owes that must be paid within a year, such as accounts payable or short-term loans. Second, long-term debt. These are obligations that last over a year, like bank loans or bonds. And lastly, owner's equity. This represents the owner's investment and retained earnings. Understanding these components help us see how a company is financed. So let's move on to the financial structure versus capital structure. Many people confuse financial structure with capital structure. Here is the difference. Financial structure includes all liabilities, both short-term and long-term, as well as equity. While capital structure, on the other hand, only includes long-term debt and equity. So, capital structure is a part of financial structure. This distinction matters when analyzing risk and investment potential. So, let's proceed to the importance in accounting management. A strong financial structure is crucial for effective management. It affects the cost of capital, how expensive it is to raise money. It influences financial risk. Too much debt can lead to bankruptcy. It also affects credit worthiness, which is how lenders and investors see the company. Lastly, it helps a business stay flexible and ready for opportunities and emergencies. So let's move on to the factors affecting financial structure. First, we have the nature and size of the business, the stability of cash flow, current market interest and investors' expectations, tax policies and government regulations, and lastly, management attitudes toward risk. This includes the nature of the business. For example, a manufacturing firm may need more financing than a service company. Cash flow stability matters too. More stable income allows for more borrowing. We also considered market conditions such as interest rates. Tax policies may encourage or discourage borrowing. And lastly, management risk tolerance will guide whether they prefer debt or equity. So let's proceed to financial structure ratios. To measure a company financial structure, we use several ratios. First is the debt to equity ratio compares what the company owes versus what it owns. Para makuha natin yung debt to equity ratio, we need to divide the debt or yung utang sa shareholders' equity. Second, the debt ratio tells us what portion of assets is funded by debt. So, we need to divide the debt, the total liabilities, sa total assets. Third is the equity ratio. Shows the part financed by shareholders. Para makuha natin yung equity ratio, need natin i-divide yung shareholders' equity sa total assets. And lastly, the interest coverage ratio. Help us see if the company can pay its interest. Para makuha natin yung interest coverage ratio, we need to get the EBIT or the earnings before interest and taxes. Then, i-divide natin ito sa interest expense. These ratios are used by investors and managers to evaluate financial health. So, ang example ng debt to equity ratio is yung total liabilities, i-divide mo siya sa total shareholders equity. For example, kung ang company meron siyang total liabilities na 1 million and meron siyang shareholders equity na 800,000, so, bali, i-divide mo sila. Yung 1 million, i-divide mo doon sa 800,000, bale, ang total niya is 1.25. So, this means the company has 1.25 of debt and for every peso of equity. Sa debt ratio naman, Ang formula nito is total liabilities over total assets. For example, if may total liabilities yung company ng 1,200,000 and total assets ng 3,000,000, i-divide mo yun sila. Bali, 1,200,000 divided by 3,000,000 is equals to 0.4 or 40%. This means 40% of the assets are financed by debt. Sa equity ratio naman, para makuha natin yung equity ratio, yung total shareholders equity, i-divide natin siya sa total asset. For example, if meron tayong shareholders equity na 1,800,000 and meron tayong total assets ng 3,000,000, i-divide natin yung dalawa. So, 1,800,000 divided by 3,000,000 is equals to 0.6 or 60%. This indicates 60% of assets are funded by owners. So, sa interest coverage ratio, para makuha natin yung interest coverage ratio, we need to divide the EBIT sa interest expense, yung earnings before income and taxes. So, if meron tayong operating income na 500,000 and meron tayong interest expense na 100,000, i-divide natin yun. Bale, 500,000 divided by 100,000 is equals to 5. This means the company can cover interest payments 5 times over with its operating income. So, let's proceed to optimal financial structure. An optimal financial structure strikes a balance between risk and return. Too much debt increases financial risk, while too much equity may dilute returns. Companies aim to minimize their weighted average cost of capital or WACC to improve profitability and attract investors. The goal of financial management is to find the optimal financial structure. Too much debt increases the risk of bankruptcy, and too much equity may be expensive since shareholders expect high returns. A good balance lowers the weighted average cost of capital, or WACC, and improves profitability. Each company has a unique sweet spot based on its industry, size, and goals. So, let's proceed sa practical application. Using a company's balance sheet, managers can calculate financial ratios and assets, whether the financial structure is too risky or conservative. For example, a 1:1 debt-to-equity ratio indicates a balanced structure. Let's look at the simple example. Company ABC has 10 million in asset, 5 million in debt, and 5 million in equity. Its debt-to-equity ratio is 1:1, which means it has balanced financial structure. This helps us visualize how numbers reflect financial health. Companies use this calculation to guide decisions about borrowing and investing. So let's proceed to challenges in managing financial structure. Managing financial structure involves challenges like overborrowing or underfunding, volatile interest rates, changing tax laws, economic uncertainty, and stakeholder expectation. Accounting managers must regularly review and adjust the structure to remain competitive and financially healthy. Maintaining a solid financial structure is not easy. Some challenges include taking on too much debt, rising interest rate, and changes in tax laws. Companies also face pressure from investors to deliver returns and from the global economy, which can affect cost and risk. That's why financial structure needs regular review and adjustment. So, in conclusion, the financial structure is a vital part of a company's accounting and management system. It determines how effectively a business can fund its operations, manage risk, and achieve long-term goals. A sound financial structure not only supports daily operations but also builds the foundation for future growth and stability. Financial structure is a foundation of business financial decisions. It affects risk, cost, and growth potential. A company's success depends on choosing the right mix of debt and equity based on its goals, environment, and management strategy. Thank you for listening, and I hope you now have a clearer understanding of how financial structure plays a crucial role in accounting and management.
Moving forward, let us now talk about the optimum capital structure or OCS, which is one of the most important concepts in financial management. So basically, this topic is all about how a company manages its mix of debt and equity para ma-maximize ang value ng company while minimizing the cost of capital. By its definition, optimum capital structure means yung tamang balanse ng utang or what we call the debt at ng equity. Ang goal kasi natin dito is para ma-reduce yung overall cost of capital and at the same time para pataasin yung market value ng company. Or kumbaga sa pagtimpla ng kape, dapat sakto lang yung sugar at yung coffee dahil kapag sumobrang isa, hindi na siya masarap. Ganon din sa debt and equity, kailangan sakto lang para mag-work siya. Next, application and business. Ngayon, paano ba or bakit ginagamit ng mga businesses ang optimum capital structure? Well, we have a lot of reason and ito yung iba doon. First is to enhance profitability. Dahil kapag mababa ang weighted average cost of capital or WACC, mas mataas ang net income. For example, Jollibee Food Corporation uses mix of bonds or debt and equity para mas mura yung financing ng expansion nila abroad. And dahil dito, mas lumalaki pa yung kita nila. Second is to support growth. Dahil efficient capital structure gives enough funding for expansion. For example, a startup tech company na gustong mag-launch ng bagong app, gumagamit sila ng partly investors' money and partly business loans or debt para makapag-expand sila ng mabilis while maintaining stable finances. Third is to maximize shareholders' value. Now, you might ask me, sa papaanong paraan na ma-maximize ang shareholders' value in this sense? Well, hindi talaga natin may kakailan na it is easy for a company to take debt to keep the production going as it is the least costly form of capital. However, excess borrowing not only increases firm's risk of bankruptcy but also affect its ability to pay dividends. In the event of loss, the firm still has to make interest payments on debt, and as a result, it reduces the profit available for dividend distribution. Kaya ang optimum capital structure has this effect of maximizing the shareholders value dahil or shareholders equity dahil kapag balance yung capital structure na ma-maximize natin yung shareholders value. Next, we also have factors affecting optimum capital structure. So marami tayong factors na nakakaapekto sa kung paano natin na-achieve yung OCS or optimum capital structure. First is the cost of debt and equity. Siyempre, mas maganda kung mababa yung borrowing cost at reasonable yung returns na nakukuha natin. For example, a big company like SM Prime can borrow money from banks at a low interest kasi nga malaki at stable yung business nila. Second, business risk. Kung stable ang cash flow, kaya ng company mag-take ng more debt. For example, Meralco, dahil predictable yung income nila kasi nga monthly bills, di ba? Kaya nilang kumuha or mas mataas yung debt capacity nila since stable nga sila. Third is tax considerations. Kasi tax deductible ang interest ng utang. Kaya attractive ang debt financing. So, maraming company actually ang mas prefer nila ang loans kasi nga mas makakatipid sila sa taxes through deductible interest. Fourth is market conditions. Kasi there are also some instances na nakadepende sa ekonomiya at financial market trends. Like kapag recession, mahirap umutang or maglabas ng equity, di ba? For example, yung during pandemic, maraming business ang nag-struggle to borrow dahil mahigpit ang bangko. Kasi nga, we are in a recession point. 5, company size and industry. Ito, importante rin siya. Importante rin to. Kasi usually, yung mga malalaking firms and mas stable industries have higher debt capacity. Just like what I've said earlier sa business risk. Example, ang Ayala Corporation can easily raise billions through bonds dahil nga kilala sila at saka stable sila. However, we also have challenges in using optimum capital structure. Ika nga nila, nobody is perfect. Kaya kahit ang optimum capital structure ay hindi rin perfect. May kakibat itong mga challenges tulad ng first, dynamic nature. Second, risk of over-leveraging. And third, subjectivity. Dynamic nature, bakit? Kasi nga nagbabago-bago ito depende sa market at internal conditions. Second, risk of over-leveraging. Dahil kapag sobrang utang, baka mauwi tayo sa financial distress. Kagaya ng nangyari sa Hanjin Philippines, which is a shipbuilding company, na nalugi dahil sa sobrang laki ng utang nila, hindi na nila na kayang bayaran. Third is subjectivity. Dahil kasi hindi laging eksakto ang computation, madalas may assumption at forecast tayo na ginagawa. For example, ang startup business na umutang ng malaki kasi nga ang forecast nila is mataas yung sales nila for the upcoming months. Pero kapag hindi yun natupad or kapag mababaling yung kita nila, mahihirapan sila na i-manage yung utang nila. Now, paano ba natin na-measure or kina-calculate ang optimum capital structure? To further enlighten us on this matter, let us have Ms. Resaifa Cuaro.
We are now in the calculation and interpretation part of the optimal capital structure. So here we have the weighted average cost of capital. So as shown in the screen, the optimum capital structure is calculated by minimizing the weighted average cost of capital. As shown in the slide, the formula for the weighted average cost of capital. But first, let us define the terms that will be used in the formula. So first we have E, which is the market value of equity, the D, which is the market value of debt, V for the total capital, which we can get by adding the equity and the debt, RE, which is the cost of equity, the RD, which is the cost of D, and the T, which is the corporate tax rate. So, dito meron tayong example. No? So, if a company has 4 million in equity and 1 million in debt, then the proportions are, so first, kukunin muna natin yung equity over total capital and yung debt over total capital. So, as mentioned earlier, yung total capital nakukuha siya by adding the equity and the debt, which in this case is 4 million plus 1 million, which is 5 million. So, para makuha yung equity over total capital, we will divide 4 million by 5 million, which will give us 0.8. And yung debt over total capital naman is 1 million over 5 million, which will give us 0.2. So, kapag nakuha natin yung dalawang value na yon, meron na tayong mga given na rates, no, which is yung cost of equity na 10%, cost of debt na 6%, and yung tax rate na 30%. So, since nakuha na natin yung mga values, i-substitute na lang natin yun doon sa formula earlier, which gives us 0.8 multiplied by 0.10 plus 0.2 times 0.06 plus 1 minus 0.3, which will give us 0.08 plus 0.0084, which is equals to 0.0884 or 8.84%. Okay, so how do we interpret that result kanina, no, yung 8.84%, yung nakuha natin sa weighted average cost of capital? Sabi dito, a lower weighted average cost of capital indicates an efficient capital structure as it reduces financing costs and enhances profitability. The point where the weighted average cost of capital is minimized represents the optimum capital structure. So, sa madaling salita, no, the lower your weighted average capital or weighted average cost of capital daw, the better profitability the entity or the company has. Kasi ang pinapakita or nire-represent ng weighted average cost of capital is yung financing costs ng isang company. Therefore, the lower it is or the more minimized the result is, that means mas maliit or mas reduced yung financing cost ng company. Therefore, mas mataas yung profits. To conclude, determining the right capital structure is essential for a company's financial stability and growth. It's not just about balancing debt and equity, it's about aligning this balance with the company's goals, market conditions, and risk profile. Since these factors change over time, businesses must continuously review their structure to remain competitive and ensure sustainable long-term success.
Let's move on to capital structure theories. Capital structure theories introduction. Capital structure refers to the mix of debt and equity that a firm uses to finance its operation and growth. The choice of capital structure is a critical decision for firms as it influences their cost of capital, risk profile, and overall value. In this introduction, in this paragraph, it just states that the capital structure is the mix of equity and debt in financing the operations of a firm, and also shows how it influences the value of the firm. Yun lang siya. Like, the debt and equity in financing the firm, tapos how it affects the value of the firm. So, yun lang. And moving on, meron tayong chart here in the next slide. We have the capital structure at the top, then below it is the theories of capital structure, and then sa right side banda, we have the relevance of capital structure. Yan. We have two, the net income approach and the traditional approach. In relevance of capital structure, it just implies that there is a relationship between the debt and equity and the value of the firm. Yun lang siya. Like the value of the firm is dependent on the debt and equity of the firm. And then, sa kabila naman, sa left side, we have the irrelevance of capital structure. We have here the net operating income approach and the Modigliani-Miller approach. Here sa irrelevance of capital structure, kabaliktaran lang siya ng relevance. Diba sa relevance is, there is a relationship between the value of the firm and the debt and equity of the firm. Dito naman sa irrelevance, there is no relationship between the debt and equity and the value of the firm. Like, it is independent. Ayun. So, like, hindi nakapektuhan talaga yung value of the firm, whether the debt or equity increases or decreases. Yun lang. Let's move on sa net income approach under the relevance of capital structure. Net income theory was propounded by David Durant and is also known as fixed key theory. The capital structure of a firm influences its cost of capital and thus directly affects the value of the firm. Directly affects, ayan. Since sa relevance of capital structure, di ba ang sabi, it is dependent on the debt and equity. So, sa net income approach, it directly affects the value of the firm. Ayun. So, we have the assumptions. We have here, the net income approach assumes that there is only two sources of finance, which is the debt and the equity. So, next, there is no corporate tax. Third, the value of company is dependent on the capital structure of the firm. Fourth, cost of debt is less than the cost of equity. Why? Because most investors don't take the higher risk of investing onto something, diba? Like, they avoid investing on something na may high risk. So, lastly, a continuous increase in debt does not affect the risk perception of investors. In this last assumption, it just assumes that all investors think the same way. Yun lang siya. So, if hindi good nakaka-apekto sa isang investor, they assume that it does not affect all the other investors. Here we have the overall cost of capital and the value of the firm, which states that increase in overall cost of capital decreases the value of the firm. Ayun. Tapos, if the cost of capital decreases, the value of the firm increases. Okay, next slide tayo para mas lalong maintindihan. Here, we have the formula for the value of the firm under the net income approach. V is equals to S plus B, where V is the value of firm, S is the market value of equity, B is the market value of debt. Para naman makuha natin ang cost of capital, we have the formula where KO is equals to EBIT or EBIT over V, where KO is the cost of capital, EBIT is the earnings before interest and tax, and then V is the value of the firm. Makikita natin here sa graph para mas maintindihan. We have here the debt. KD stands for cost of debt, KE for cost of equity, KO for cost of capital, and cost at the top part. To define na lang muna natin. KO is the average return that the company must pay the investors. Yun siya. KD is the effective interest rate that the company pays for the borrowed funds. Tapos, ang KE naman natin is the expected returns of the shareholders. Yun lang siya. So, makikita natin dito sa graph. As the debt increases, ang ating cost of capital decreases. Itong KO, it decreases. Pero, mas maiintindihan natin siya with an example. Next slide kayo. We have here, mag-focus lang tayo dito sa mga yung given dun sa formula natin sa kabilang slide. Since here kasi, nag-breakdown talaga siya. Pero, mag-focus muna tayo here sa ating debt. Makikita natin dito yung debt. Value of debt, as you can see, we have here, sa case 1, we have 500. Sa case 2, we have 700. Sa case 3, we have 200,000. Dito, para makuha natin yung value of firm, makukuha natin yung value of equity muna. Value of equity natin sa case 1 is 1,700,000. So, i-plus natin yan siya sa value of debt na 500,000, which is 2,200,000 ang value of firm. Same process din sa case 2 and case 3, which gives us the value of firm sa case 2 na 2,280,000 and sa case 3 na 2,080,000. Para naman makuha natin ang ating cost of capital or itong WACC or the weighted average cost of capital, EBIT is divided by the value of firm times 100. So dito, ang ating EBIT nasa taas, sa case 1 natin is 200,000, sa case 2 natin is 200,000, equal na yan sila lahat. Bale, ang EBIT natin, i-divide natin sa value. So, yung EBIT natin, try natin sa case 1, sa EBIT natin, 200,000 divided by the value of firm na 2,200,000, which gives us the cost of capital na 9.09%. So, same process with all. Makikita natin dito na nag-decrease sa case 2. Tapos, nag-increase ulit sa case 3. Paano yung nangyari? Bumalik tayo sa value of debt. Let's go back sa value of debt. Makikita natin here sa case 1, ang value of debt is 500,000 only, and then in case 2, it increased to 700,000, which caused our cost of capital to decrease. And then in case 3, it decreased, and then the cost of capital increased. Ayan. So, as the value of debt increases, our cost of capital decreases. So, bumalik tayo dun sa graph. Yan, tugmang-tugma siya. Why? Because as the debt increases, look at the KO, the cost of capital decreases. Moving on sa traditional approach. Here sa traditional approach, it also supports the relevance of capital structure, where the theory was propounded by Ezra Solomon, also known as intermediate approach, mixture of NI, the net income approach, and the NOI, net operating income approach. According to this view, the form value increases to a certain level of debt capital, after which it tends to remain constant, eventually begins to decrease if there is too much borrowing. So, here sa approach na to, it believes that there is one last point where a mix of debt and equity will maximize the value of the firm. Where merong part na magde-decrease muna ang ating cost of capital, and then after niya mag-decrease is mag-sustain na lang muna yan siya dun sa part na yun sa baba, and then afterwards it will start to increase, and then mag-increase siya na mag-increase after mag-increase nung debt mo, diba? So like at the start, it just believes that pag may debt ka, bababa muna yung cost of capital mo, and then afterwards magiging stable yan siya, and then pag the more debt you have, the more it increases. So, mag-i-increase na yan siya continuously. And then, here, we have the 3 approach works. 3 stages the approach works. We have first, the value of the firm increases with an increase in borrowing. As a result, the WACC or the cost of capital reduces gradually. Ayan. So, eto na yun siya. Like, pag nagka-debt ka, increase in debt will decrease your cost of capital. However, this phenomenon is up to a certain point. In number 2, at the end of this phenomenon, reduction in cost of capital ceases and it tends to stabilize. Further increase in borrowings will not affect the cost of capital, and the value of the firm will also stagnate. So, since bumaba na siya, bumaba na yung cost of capital mo, there is a certain point na hindi na maapektuhan yung cost of capital mo, in which stabilize na siya. And then, in third stage, increase in debt beyond this point increases the shareholders' risk, and hence, cost of equity increases. Cost of debt also rises due to higher debt. Cost of capital increases and the value of the firm decreases. Ayan. Since yung cost of capital natin nasa baba na, increasing cost of debt will also increase our cost of capital. Yan. Since, ang sabi nga dito, higher risk or higher debt will increase the cost of equity, since it will demand a higher return. And then, here sa graph, to further explain it, we have here the same formula used in the net income approach. However, dito sa graph natin, makikita natin here that continuous increase in debt, then continuous increase in cost of debt here sa ating KO or the cost of capital, as said, di ba, from top, so magdi-decrease yan siya since yung debt natin is naapektuhan niya yung cost of capital natin. So magde-decrease muna yan siya pero at a certain point lamang. And then after nyan, since nasa baba na siya, it will start to increase na din pag may yung sa certain point na yun. Pag na-meet niya na yun, and then mag-start na siya mag-increase with the increase of debt. So mag-start siya na mag-increase siya na mag-increase, and then sa ating cost of equity, likewise na din siya, mag-i-increase na din siya since yun nga, higher risk ng debt will also demand a higher return sa ating investment. Ayan. So, itong graph na to will show the how it works, yung traditional approach from sa top tapos bababa, then magsa-stabilize siya, and then i-increase ulit siya due to increase in debt. So, here's sa ating example for it to be more understandable. Let's just focus once again dun sa mga given na sa ating formula since breakdown talaga itong nakuha nating example. Focus tayo sa debt. Here, sa debt component, we have the presently case 1 and case 2. Sa present, we have 0 debt. In case 1, we have 300,000 debt, and then case 2, 500,000 debt. Then, to have the cost of equity, it is given 16 for present, 17 for case 1, and then case 2 is 20%. That's the cost of equity. And then, to have the value of equity natin is, yan, sinolve niya since breakdown nga talaga siya. So, mag-focus na lang muna tayo sa value of equity na agad. So, para makuha natin yung value of the firm, i-add natin yung value of equity and the debt. So, itong value of equity natin sa present, wala tayong i-add since wala namang debt na binigay sa present. Here sa case 1, meron. So, in-add siya, 705,882 plus the 300,000 is 1,005,882. In case 2, in-add din siya, which gives us 450,000. I mean 950,000. 500,000 debt, and then 450,000 na value of equity. Ayan. Those are our value of firm. So, para ma-compute natin ang ating cost of capital, same with the formula from net income approach, our EBIT divided by the value of firm. So, yung EBIT natin na here, 150,000 sa present. I-divide natin siya sa value of firm na 937,500, which gives us 16%. So, here naman sa kabila, same process, which gives us 40.91, and then same process with case 2, 15.79. Going back, tingnan natin ulit ang ating debt. We have here sa present 0. Then, nag-increase siya sa case 1, and then, nag-increase pa siya lalo sa case 2. Makikita natin here sa cost of capital. First, sa present is 16%. And then, nag-decrease siya. Even though na nag-increase yung debt. And then naman, sa case 2, nag-increase pa lalo yung debt. Pero, nag-increase din yung cost of capital natin. This is a perfect representation or illustration ng ating traditional approach. Yun na yung curve sa graph natin. So, from higher percent to lower, and then nagtaas na naman siya. Yun lang yung concept niya. And then moving on, we have the third approach, the net operating income approach. This is under the irrelevance of capital structure, which believes that there is no relationship between the value of the firm and the debt and equity of the firm. Yun lang siya, like, the value of the firm is independent on the debt and equity of the firm. Here, net operating income was propounded by David Duran and is also known as irrelevant theory. Grabe, no? He propounded the net income approach and also propounded a theory that is contradicting the other theory na ginawa niya. So, as per net operating income approach, value of firm is not dependent upon its capital structure. Ayan. So, we have here the assumptions. There is only two sources of finance, debt and equity. The cost of capital is always constant and it depends on the business risk. Third, value of the firm is calculated using the overall cost of capital. Fourth, the cost of debt is constant. Fifth, corporate taxes do not exist. Yun, parang same lang din siya dun sa net income approach na assumptions. However, meron din silang pagkakaiba dito. Here sa table, we have the cost of debt, KD, the cost of equity, KE, which shows that decrease in cost of debt will cause to decrease the cost of equity. Tapos, increase in cost of debt will increase the cost of equity. To further explain it, next slide tayo. Here's a graph and the formula. Here's the formula. It is also same with the... No, it is not the same. So, V is equals to EBIT over KO, or the cost of capital. Cost of equity is equals to EBIT minus interest, or I, over the S, or the market value of equity. Here's a graph. Let's move on. Let's look at the graph. Meron tayong debt, KD, KO, KE, and cost. Same given. So here, increasing debt will increase the cost of equity. Ayan. It's only the debt and equity na. So, increasing debt and then increase in equity. That's the concept here sa approach na to. Let's look sa example to be more, to elaborate it more. Ayan. So, let's look on the value of debt. Ayan. 300,000 in option 1, option 2, 400,000, option 3, 500,000. Actually, let's just focus on the concept muna and then discuss the solution in the face-to-face classes. So here, since the debt is increasing in the examples, let's look at the cost of equity. Ayan. Since the cost of debt is increasing, our cost of equity also increases. The cost of equity is computed by dividing the EBIT minus the interest over the value of the equity, value of equity, market value of equity. So here's the option 1, we have the 182,000 divided by the 1,700,000. which gives us 10.71%. That's the process. And then same process will apply with the option 2 and option 3. Para makita natin na increasing debt will increase the cost of equity. That's the main point of the net operating income approach. Ayan. So, let's move on to the last approach, which is under the irrelevance of capital structure. Ayan, sa pinaka-last na tayo. Malapit nang matapos. The Modigliani-Miller is developed by Merton Miller and Franco Modigliani. Here, Modigliani-Miller approach supports that a firm's value is determined solely by its earning power and asset risk, with the overall power of levered firm with debt being equal to unlevered firm without debt. Tandaan natin yung terms na yan. Levered is a firm financed with debt, and then unlevered is financed without debt. Ayan. We have here two propositions of Modigliani-Miller approach. We have the proposition 1. The value of a firm is independent of its capital structure. Whether the firm is levered or unlevered, its total value is the same. Yun lang ang proposition 1. Whether the firm is financed with debt or without debt, whether the firm is levered or unlevered, the value is equal. Ayan. In proposition 2, cost of equity increases linearly with leverage. In proposition 2 is the same with the concept of net operating income, wherein increase in debt will increase the cost of equity. Yun lang siya. So here is the formula for the unlevered firm and the levered firm. In unlevered firm, we have the VU is equals to EBIT over KO. Same with the formula sa other approaches para mahanap yung value of firm. And then, in levered firm, it is VL is equals to VU. Why is that? Let's go back sa proposition 1 ng Modigliani-Miller approach, wherein sabi dito, whether the firm is levered or unlevered, its total value is the same. That's their point. Like whether it is with debt or without debt, its value is equal pa rin. So, let's look at an example to be more Ayan, we have calculation and interpretation. We have the problem of ABC Company. ABC Company has an annual operating income, EBIT of 1 million. The overall cost of capital for the firm is estimated 10%. The company is evaluating two capital structures. We have first, unlevered firm, financed entirely by equity. Levered firm, financed partly by debt of 2 million at an interest rate of 5%, with the remainder financed by equity. Sa ating value of unlevered firm, let's go back sa ating formula. VU is equals to EBIT over the cost of capital. VU is equals to, ang ating EBIT is 1 million. So, 1 million divided by our cost of capital na 10%, which gives us the value of unlevered firm na 10 million. So here, sa value of levered firm, since the concept is that the value of levered firm and unlevered firm is the same, so i-equal na lang natin siya. So value of levered firm is also equals to 10 million. In cost of equity under the value of unlevered firm, it is computed as EBIT over S, or the cost of equity, or the market value of equity. Para makuha natin yung cost of equity, ang ating EBIT is 1 million divided by the market value of equity na 10 million, which gives us a 10% cost of equity. Yan siya i-solve. And then, sa cost of equity under the value of levered firm, we have the formula of cost of equity is equals to EBIT minus interest over the market value of equity. Paano nakuha itong 900,000? Here, we have the example sa 2 million at an interest rate of 5%. So, 5% of 2 million is 100,000. So, 100,000 yun. Babalik tayo sa EBIT natin. EBIT minus yung interest na 100,000. Yung 1 million na yun, na EBIT minus the 100,000 na interest, which gives us 900,000. And then, paano naman ito nakuha? Itong market value of equity na 8 million. So, makikita dito na yung EBIT natin is 1 million. I mean, yung value of firm pala natin is 10 million. 10 million na yun, isubtract natin yung 2 million na debt. Yan. Market value, value of the firm minus the market value of debt. 10 million minus 2 million is equals to 8 million, which gives us 900,000 divided by 8 million, and then the cost of equity is 11.25. That's the difference between the value of unlevered firm and the value of levered firm. Ayan. Let's just go back every time sa Modigliani-Miller approach to the proposition talaga. That's where it revolve. So, in conclusion, capital structure theory provides a framework for understanding how firms finance their operations and the implications of their financing decisions. So, each company, they apply different approaches talaga. So, whether it is the net income approach, the traditional approach, the net operating income approach, or the Modigliani-Miller approach, they apply those. So, it differs in every company or every firm. So, as economic conditions evolve, capital structure theory continues to inform both academic research and corporate decision-making, underscoring its enduring significance in economics. So that's why it is also important for the economy to have the study on this capital structure, since the firm mainly focuses its operation dito, and it relies strictly on the capital structure of the company. So I think that's a wrap. Yes, that's a wrap. So that ends our reporting for Group 2. I hope you did listen well and learned something from our reporting. Thank you very much.